Welcome back, everyone, to Vox Markets. My name is Paul Hill, and I'm delighted today to be able to speak to Brendan Gulston of Gresham House, one of the UK's finest investors. So welcome, Brendan.
Thanks, Paul. Good to be on here.
Yeah, well, I'll tell you, there's a lot happening, so we need your expertise here. I mean, not only have we got sort of like inflation at multi-decade highs, we've had sort of bond yields back to, in fact, higher than pre-COVID levels. And obviously, 2 months ago, we've got the Ukraine-Russian crisis thrown in for good measure. So just broadly, what's your sort of like your outlook for equities going forward?
Yeah, so look, I mean, there's clearly lots of reasons why one could be quite bearish about the outlook. Everyone's talking about rising cost of living, the price of food, energy, inflation, and, potentially a kind of rising interest rate environment. And obviously that, sort of heightened geopolitical tensions and the Russia-Ukraine crisis. But, I think, I'm pretty sort of half glass full in terms of the outlook on the UK equity markets. I think it's important to kind of think through, what impact those broader macro factors can have, and then kind of how do you play those, or how do you sidestep them? And I think, clearly those factors are going to impact both the consumer and also businesses. And, in the terms of consumer, I think, my view is we're probably going to see a kind of more, more pronounced impact in terms of perhaps bigger ticket kind of consumer discretionary. We might see a kind of shift in wallet share towards, the lower ticket, maybe kind of experiential leisure side from casual dining or fashion or other non-essentials. So, it's important to try and think about how you can sort of play that dynamic. And then, I think in terms of businesses, we've sort of been through, a period during COVID where it's been kind of artificially inflated in terms of the kind of business buoyancy and the government support. And I think as that has mostly unwound, and as it continues to do so, we'll start to see, along with the other some macro factors, some challenges in terms of certain businesses perhaps struggling to kind of trade very well. So it could be rising insolvencies, and there's a way to play that as well. But so I think, I mean, broadly, I think there's going to be probably greater variability in terms of company performance, be quite varied probably across sectors, across the situational context of companies. We have been seeing some elevated profit warnings and obviously greater market volatility. But with my glass half full hat on, I think that, you look at the UK equity markets and those remain really, really attractive. And, firstly, the kind of the performance over the last few years has been very dislocated due to COVID, and then, the kind of the bounce back and the recovery. So, there's this huge kind of valuation discount that has been present, not just in, the small cap space where it always has been, but really across the market cap spectrum. And I think as long as you do the appropriate diligence and really have discipline on quality of business, robustness, working out the true sort of earnings picture and the valuation, then I think, there's some really attractive gems to be found. And that is being, what I think the kind of a really strong validator of that is the corporate activity that we're seeing at the moment. So that, there's a big arbitrage between private market and public market multiples at the moment. That's driving private equity and corporate interest across sectors. We've seen, some of the sectors that have been much more in focus, probably in, the healthcare asset space, particularly healthcare services, niche software, financials. Those would be the key areas that we've seen so far. And, I thought actually there was a recent announcement for a company called IdeaGen, which had some takeover speculation, which was announced last week, and that is not really an obvious takeout target given the headline valuation multiples, but it just demonstrates the appetite from, in this case, private equity in the space. So I think that should be an ongoing theme. I think that's really supportive of UK equity markets going forward.
Yeah. Yeah, I mean, I'm with you. It's sort of like it's been a tough sort of 2 or 3 months, but actually the overall, as long as you get your stock selection right, and I think those big themes you've just talked about are actually coming out in the earnings season. When 2 days ago, we saw obviously Netflix, even one of the darlings of the COVID world, now actually struggling because it looks as though a lot of the UK subscribers are deciding to hand in their subscriptions simply because of price increases. And there was actually one of the building products firm said this morning, although it was seeing good trading, it sold doors and windows, I think, and then said, look, actually big ticket items, we're cautiously optimistic, but we expect to see a decrease. So I'm with you. If you've got to choose your right spots now, just on that, I mean, I was looking through your sort of portfolio, and you've got some fantastic plays on this one. The cost of living crisis. Do you want to take us through? There's three actually. There's B&M, Moneysupermarket.com, and Telecom Plus. Perhaps the sort of the discount hard retailer B&M. I mean, that's a perfect spot, isn't it? Obviously for people if consumers are retrenching slightly.
Yeah, so I mean, B&M we invested in a number of years ago, and it's really, we invested before there was the cost of living crisis because we saw really attractive multi-year store rollout growth opportunity. I think that's been put firmly back into the spotlight with obviously the challenges around the consumer. So I think this is consumer staples, everyday low pricing. It's right at the value end, and so that counter cyclicality, it should be a helpful backdrop to support the company. I think the customer proposition is really attractive, and how they blend the focus on products across segments. They're just very focused on driving in-store upsell and really margin expansion on the average basket size. What I think one of the sort of challenges people have obviously cited in this area has been supply chain. Supply chain strength for B&M. This was a sort of critical differentiator when we first invested. So I'm kind of less worried about that going forward. And then I think
where do they source the stuff? Is it China? Is it largely?
Yeah, it's mostly China. But the IP or the expertise in the business was sort of born out of that kind of focus on supply chain and direct sourcing and driving relationships to be able to ensure kind of resilience across the supply chain. So I think they're well positioned from that perspective. And then I don't think that much has changed for us really in terms of the store rollout opportunity. The business it's a very well-oiled machine in terms of the execution of the site rollout. The site economics are extremely compelling. They're less than a year cash payback on CapEx. These are out of town locations where people are willing to travel to. They're lower cost. And then, if you also think about their ability to, as an anchor tenant, to secure really attractive leases when you've got this kind of channel shift where people aren't, they're one of a very few number of companies that are actually expanding physical sites in this area across the UK. So that gives a really good leverage in terms of just sort of honing the store rollout model.
And have they got an online proposition at all, or they're a bit like Aldi and Lidl?
So they I don't believe they have an online proposition, but this is something that has been recently talked about at various sort of capital markets days, and they were sort of considering launching a foray into the online, maybe one to watch.
Oh, okay. It's been prodded by a few shareholders, I guess, because I know Primark have recently decided to reverse their previous ban on all online deliveries.
Yeah.
But anyway,
I think the challenge is the kind of looking at I suppose the total size of the average basket and then across the different products, is it economical to be delivering that online possibly?
Yeah, well, I mean, Morrison's again sort of like was adamant that they were never going to do online, and then realised Tesco's and Sainsbury's were eating their lunch, and Asda, and they just realised it was a must-have. Now moving on to another one, which actually Moneysupermarket.com, and obviously this is a sort of like the poster child of all things comparative websites. And because of the energy crunch, it obviously probably struggled, I guess, last year. And likewise with the FCA introducing sort of like price caps on insurance or regulations on insurance, it's been sort of artificially hit, which has led to the shares actually trading at a 10 times PE multiple for an online business, which seems, frankly, incredibly cheap.
Yeah, I definitely agree with that. We had been adding to it, when it sort of came off, and as you said, when it was looking very cheap. Look, it's, as you've highlighted, it's a very, very strong market position. Has very good scale. It's a extremely kind of resilient cash generator. And I think, just to sort of talk through the model, I think, one big attraction of Moneysupermarket is that it has a very diversified offering. If you look during COVID, there'll be clearly areas such as travel were challenged, but actually those were offset by other areas. So, money, for example, and, credit cards, banking, that area was very buoyant. And so, the business wasn't completely immune, but if you look at the numbers during COVID were pretty robust in terms of quite modest declines in terms of revenue and profits. And that was the diversification of the business. The dividend was robust and held throughout the period as well. So I think, from a kind of market position, business model perspective, it is quite robust. In terms of kind of high level backdrop, in terms of looking forward with, the cost of living crisis, I think the focus is very firmly back on, the consumer wallet being pinched. And this kind of throws someone like Moneysupermarket and others back into the spotlight again, in terms of, being just quite a helpful tailwind to drive demand to the website. But actually, I think for Moneysupermarket, probably the most exciting thing outside of what we talked about already, really it's a kind of, not a self-help, but it's a kind of company initiative around digital transformation. And so, the company has done a few acquisitions over the last few years. And what they've been working on, over that time is really this digital transformation program, where they are sort of trying to platformize, that's a word, the business, and kind of consolidate all of their different offerings onto a single platform. This will allow, the kind of common sharing of data for underlying customers. You'll be able to track customer journeys better. You'll be able to market better, and you put all of that together, you're going to be able to better identify customers, increases your addressable market, and it reduces your customer acquisition costs. So actually, quite some helpful tailwinds overall. But I'm probably most excited about the kind of ongoing digital transformation program, which is, starting to kind of deliver quite promising results so far.
Yeah, and also I think the actual, the shares are trading at almost 52-week lows, so deep liquidity as well. So if investors want to put some money into that type of really very strong, well-known brand, then it's as good a time as any. Now, just moving on to another one, Telecom Plus, which is a reseller, isn't it, of all things sort of utilities to consumers, which frankly is probably now the almost like one of the biggest costs for households around the country. Certainly, my energy bill has now tripled over the last 12 months and is sky high. So everybody is going to be looking for an energy company that is good value and isn't going to go bust. Yeah,
I mean, Telecom Plus, the kind of, I suppose the two sort of differentiators are, one, as you highlighted, the nature of what the business does, being a multi-utility reseller, means that the business has a structural cost advantage over others, because you can offer energy, you can offer internet, broadband, you can offer mobile, you can offer multi-utilities, but you only have one centralized set of costs. So you don't have to run the same cost base for each of those as if you were EDF and EE. They all have their own sort of singular cost structure. So that cost saving allows them to be able to offer, as long as customers buy more than one product, then they can offer, the cheapest product in the market. The second differentiator is around their route to market, which is done through a kind of, through sort of a kind of partnership with people who are, who basically sell to kind of friends and family. So they don't.
These their partner network, isn't it? Basically, yeah. Who are effectively affiliates, aren't they?
Effectively, yeah, and it makes for an easier sale, an easier conversation. Also reduces your kind of overhead cost of selling as well, and they're obviously incentivized to do so. And I think if you look historically, actually, Telecom Plus, this has been a relatively kind of boring income stock that has delivered a decent yield, but hasn't grown that much. And that has been principally because of the state of the energy market up until fairly recently, where you'll have seen the number of new entrants into the energy market who are not that well capitalized and who are essentially acting as kind of loss leaders, undercutting on price, where actually the underlying customer economics aren't sustainable, but that goes to fund future growth, and the top line grows, but these companies remain unprofitable for a long time. And that has been probably, I would say, a systemic kind of issue with the industry. The kind of huge rise in wholesale pricing for energy was basically the catalyst to kind of unearth these practices, which caused obviously half of the energy suppliers to fail, or roughly half. What has happened since then is the regulator has stepped in to kind of say, well, we don't want this to happen in the future. We're going to sort of limit the number of market entrants. We want to kind of protect this sort of ecosystem a bit better, and that has completely played into Telecom Plus's advantage, because now you don't have all the sort of loss leaders. They are now able to leverage that structural cost advantage to genuinely be the lowest priced offering in their space. So that their relative market position has now improved significantly, and we've started to see that come through in terms of the customer growth. And I think I'm getting this right when I say in October last year, I think they won more new customers than they had in the previous 12 months.
Yes, that's right.
Something of that order of magnitude. So actually, this is gone from being perhaps a bit of a kind of dull but resilient income stock to being potentially quite an exciting or very exciting growth opportunity, where you've still got that high level of yield as well. So I think that's a really exciting play in that space as well.
And what's the sort of the risk that you've with a lot of these sort of like I don't know, newbie pre-Madonna energy companies which have gone bust. I mean, it's that classic Warren Buffett, when the tide goes out, you see who's been swimming naked type of syndrome. Given that's happened, so competition has got less fierce than it was, then is there given the political sort of backdrop for the cost of living crisis, that effectively voters are going to be badgering their MP to reduce the sort of like the price of all things broadband and utility and this sort of stuff. Is there a risk that the government effectively interfere again in terms of actually put price caps on everything?
I mean, that's quite topical, and it's across the media, a lot at the moment, and there is that could happen, but I'm not sure that would necessarily be to the detriment of someone like Telecom Plus, as something like that would affect the entire market, and really their attraction is down to their kind of relative positioning within the constraints of the market. And as a reseller, they are fully hedged against the underlying input costs, so they don't take any risk there. So I don't know. Well, we could see. Depends on what was introduced, but I suspect something market wide is not going to affect them in particular.
Right. Okay. Well, let's move on now to some income stocks. Obviously, we talked about sort of Telecom Plus, which has now got a growth angle to it. But another one you've got is Balfour Beatty, which is a sort of like a £1.7 billion market cap company, and I think it's on a 10 times PE ratio. I mean, obviously, this whole sector of sort of construction contractors has been an area that investors have been very hesitant on, because it's slim margins, and you only got to sort of get a few fines or cost over, project overruns and stuff like that, and it wipes out all your profits and stuff like that. But can you just take us through the sort of investment thesis for this, particularly on the income side?
Yeah, so look, Paul, I think you're completely right in terms of the thin margin sector, and I would say the sector, UK construction has been quite out of favour really over the last sort of 3, 4, 5 years. I think that Balfour Beatty it's a global business, so it operates in Hong Kong, UK, and US. And in terms of those specific construction contracts, the reason why I think this is really attractive is firstly, it's not playing into the kind of cyclical construction sector. So if you look at the projects that Balfour Beatty is sort of working on, things like Hinkley Point, all the construction that's sort of going into that site. They're doing construction into kind of wind farms. They're doing HS2. So the kind of government-driven infrastructure agenda is a big sort of driving force for the work that they're doing, as is the kind of sustainability agenda as well. So so these are kind of structurally driven projects as opposed to being kind of cyclical. I think the other thing is that Balfour Beatty has changed a lot in the last 5 years. So you're right. The sort of critical risk here is that contractual risk and being able to absorb and pass on costs and inflation. And, the business has gone through a period of really, restructuring those contracts so that they have risk sharing frameworks across the vast majority of their portfolio where they're able to pass on costs or they have a kind of minimum level of profit that they'll achieve. So that I think has been that's been a really big change for them in terms of the quality of the earning streams. What I'd say about the projects themselves as well, these are very big projects where Balfour Beatty is playing a critical role. They have a strong kind of position in terms of leverage with the public sector, and they're kind of project managing all the other sort of bits of the supply chain. So. It's not like they do have some exposure to kind of smaller projects, but most of their sort of order book and their pipeline is, these quite critical large projects. But you know what? If I think that potentially the most interesting thing about Balfour Beatty is you can basically ignore all of that, ignore the earnings business.
Yeah.
If you look at the infrastructure investment portfolio, which is valued at £1.1 billion. Most of those assets, by the way, are positively correlated to inflation. So, these are long-dated RPI-linked cash flows. So in the current environment, where inflation's running ahead of interest rates, those are looking very attractive. They then have average net cash of, I think it was 670 million. At a 1.6 billion market cap, you can take a haircut to the net cash and you're still getting the earnings business for zero. Yeah. And the earnings business made 181 million profit in 2021. So there's something definitely out of kilter with how the market's sort of perceiving this business and sort of valuation.
Yeah, they've got a £16 billion order book. So if you want a steady good grower with plenty of forward visibility and it looks as though it's got a reasonable sort of balance sheet, if it's got sort of net cash on it, then Balfour Beatty looks a good play. Now, just moving on to sort of like the golden era of healthcare, sort of, and what I find is quite interesting actually is that your portfolio is very much along the lines of lower risk sort of med tech, established medical businesses, sort of GARP stocks, rather than your sort of your blue sky drug discovery one shot wonder type equities. And do you want to take us through? We've got on that med tech theme, we've got Medica or Medica, we've got Kooth, and then we've got IXICO. So perhaps Medica, which I think is a sort of like a teleradiology business that looks at the sort of MRI scans and does all this for the NHS and private hospitals.
Yeah, so look, I mean, in terms of healthcare, I mean, it really is a sort of golden era for healthcare, and I think that this space, healthcare, life sciences, is over the next 5, 10 plus years, this is going to be a sector that really changes dramatically and transforms. And I think as that ecosystem changes, there will be huge investment opportunities. And it's really, we spent a lot of time working out how to play those in a way that fits the kind of risk profile. Because, yeah, as you said, we have no interest in sort of binary outcome drug development, that type of thing. We're really focused on, software, technology, data analytics businesses and services businesses into the space. So yeah, I think, look, really exciting, and we've had a number of good exits to date so far. And the ones that you've mentioned just now. So Medica, so Medica's it's a teleradiology services business in the UK. It's the market leader. That market is structurally underserved from a kind of radiologist perspective, and you've got an increased demand for clinical imaging. So the market backdrop is very attractive.
Yeah, there's 6 million people waiting on the patient list, isn't there, at the moment? So many of those need scans.
Yeah, and that's been, it's sort of been, I mean, this is one of those odd markets that has been in this kind of disequilibrium of supply demand for a long time, and kind of doesn't look like it's improving that much, which is great for Medica. But look, they've been investing quite heavily into their digital platform to really kind of further cement their market position. So, improving the experience for the radiologist, improving the productivity for the radiologist, and really driving operational efficiency, as well as sort of enabling the onboarding of kind of third-party AI solutions. And that's been something that's been talked about for, I think since the IPO is this just going to be replaced by AI? And, I think that's a very superficial kind of view, because ultimately, it's not going to be fully replaced by AI, and it's going to be the businesses that, we'll go on to talk about IXICO a bit later, but the businesses that combine kind of human interaction with software and machine learning algorithms will drive probably the best uses of automation and the best outcomes. So I think they're positioning themselves on the right side of that. And they did a acquisition in the US of a business called RadMD, which has given them kind of imaging exposure in the clinical trial market, which is, again, a really big growth space. They've got exposure in the Irish market, which is sort of five or so years behind the UK in terms of that outsourcing trend. So that should, again, drive good growth going forward. And then you put that together and you look at, the kind of valuation multiple that it trades on, sort of 11 or 12 times EBITDA. Yeah. Compare that to, go back to my original, sort of one of my opening comments around the kind of arbitrage in public versus private company space. And, we're seeing private equity transactions in this space at sort of 15 to 18 times EBITDA. So, decent growth plus sort of either a re-rating on the market, or if not, then, kind of potential arbitrage on a takeout.
Yeah, just on that sort of like the theme of all things sort of data analytics in medical science and AI, etc. Should we move on to IXICO now? Yeah. Which is basically doing that model in neuroscience. It came out with a nice little contract this morning, and it backing up another contracted one as well. Do you want to take, because the shares have been pretty lackluster actually, but. Assuming that this one actually does continue to grow and the science is top notch, then it should do very well.
Yeah, look, I mean, so IXICO it's an imaging analytics business. It's focused on the clinical trial space, and it's again focused in the sort of neurodegenerative area. We invested in this quite a number of years ago. I think it was definitely over 3 years ago. When the business was much smaller, and what we thought was really attractive was, firstly,
it's pretty small now. It's only got a market cap of about 20 mil.
Yeah, it's done a bit of a round trip actually, but but it's interesting because the fundamentals of the business have. I mean, they did lose quite a big contract, which is just one of the vagaries of being in this.
I think it was with Roche, wasn't it, or something, if I remember rightly.
Yeah, I'm not sure it was disclosed, but it was. No,
I don't think it was disclosed. It was just basically, it was obvious that because they were doing all the neuroscience on it.
Yeah, and yeah, so I think, I mean, look, if you sort of take a step back, the CNS therapeutic area is a huge market, and we're seeing very sizable R&D investment into that space. there was, the first drug approved for Alzheimer's, which, actually from a kind of clinical efficacy perspective doesn't look that promising from the conversation.
That's the Biogen one, isn't it?
Yeah. But whether you think that's going to be a good drug or not, that sort of events like that paved the way for an ongoing acceleration in R&D dollars put into this space. So I think that area is really attractive. And then you've got this big trend of the kind of increasing use of imaging analytics, data, and really combining that kind of specialist neuroscientist skill and expertise with AI and algorithms, so that you can try and identify and measure things like brain atrophy, with much more precision, or you can look at kind of volumetric patterns or blood flows within the brain, and I think that, the combination of man plus machine is much better than just using one or the other here. So I think that has been something that you've seen increased adoption by the kind of pharma and biotechs, and IXICO is a kind of specialist in that market, has been really well positioned to grow. And when we invested, they're trying to get into bigger study areas and wanting to do sort of phase 3 studies, and we saw great growth from them as they announced some phase 3 studies, and one saw really good sort of contract momentum. And the other kind of play here was the sort of margin expansion, because as you use kind of more AI, you start to boost your gross margin. And we saw both of those play out kind of much faster than expected. Business became profitable, cash generative, and as you sort of said earlier, the shares responded very well, but then they were sort of hampered by a bit of bad luck in terms of a study which was cancelled. But as I said, this is it's just the nature of the market, and ultimately through diversification, you have to try and sort of build resilience against that. And ultimately, I think that the long-term fundamentals in this market and with that business, I think, are really, really sound. And actually, I think the shares are probably kind of overdone at these levels.
Yeah, well, I mean, I definitely need some help on the neuroscience myself, so I'm sure there are plenty of people like me going forward who will need their expertise, and also the business model. I mean, you've got, I think it's Cambridge Cognition, who are also in the small cap space. They've managed to make a good, profitable business model. So there's no reason why IXICO can't. Now, just moving on to something else, which obviously came through from the pandemic, and it's quite near to my heart, actually. Mental health, just simply because my wife works at a school whereby obviously a lot of sort of children, senior school, a lot of teenagers have been suffering because of lockdown, because of mental health, etc. And I think Kooth, which is one of the last sort of the big medtech in your portfolio, has done very well. It's the UK's #1 at sort of like providing digital mental health in the UK. And do you want to take us through that sort of that growth trajectory and what's attractive about it? Yeah,
and look, I think it's this is another structurally underserved market that has really sort of come right into the kind of crosshairs of the NHS and in terms of media and kind of public opinion as well. So I think you've got big tailwinds for the space, and I think if you look at Kooth, they sort of focus on a kind of digital mental health care platform for children and for sort of younger people, again, where there's this is a bit of a convergence in terms of where most of the attention is being driven at the moment. So you're seeing NHS priorities in terms of digital and also this mental health focus are sort of really underpinning the investment case here. I think Kooth also has it's starting to show growth in other areas, so looking into adult and commercial segments, and also in the US. I think what they do really well, as you sort of highlighted, that they've got a market leading proposition in this sort of focus space, and really targeting the kind of early intervention stage, which again is going back to the NHS Trust. That's kind of where they're looking to try and reduce overall healthcare costs and ultimately improve the sort of patient outcome. You have to focus at the early intervention stage. The business has been in investment mode really since IPO. It's been building out the kind of people and the tech platform really to provide this kind of operational scalability for the future, so that they can take advantage of the market opportunity ahead of them. So I think that's kind of, it may not be quite profitable, cash generative yet, but I think that's a really attractive sort of multi-year growth opportunity.
Yeah, I mean, mental health has been so poorly served for decades, and now that it's really become front and center, and frankly, it's been treated. If you have been treated, you've been lucky. But even though it's largely been treated through drugs and stuff like antidepressants, which is never going to help anybody anyway. So just a broad,
definitely been the poorer cousin of the NHS focus on basic physical health over the last sort of 10 years.
Just a broader sort of like question, I guess, when it comes to sort of medtech and AI, in medicine and, big data, and that, covering obviously IXICO, telehealth, obviously with radiology and stuff like that. And also is the sort of competition, because you've got a lot of investment dollars going in from the likes of Google, Apple. You've got your established players in the States, Teladoc, and also American Wealth. And I think even private equity are getting involved, because I did see one of the big San Francisco tech boys bought out IBM's Watson Health division as well. So you've got a lot of people playing in this. Is it really the tide will lift all boats, or is that a sort of concern going forward?
I think it depends on where you're playing in the market. So you're right in terms of people like IBM, Apple, Google have significant budgets. They are investing money to try and solve certain problems. And as an example, I think it was Google's DeepMind. They became, I think, the first company to solve, a kind of long-standing problem around, the 3D protein folding structure in drug discovery, purely using kind of AI. Yeah. And I don't know what the cost of that would have been, but it would have been, that would have been a distinct problem that would have required a lot of investment, a lot of people, a lot of sort of development spent to solve. And I think those companies can do that. And, if you look at, as an example, if you look at kind of this AI for drug discovery area where, there's been a lot of investment poured into companies that are trying to essentially identify targets and screen candidates and work out how things, bind to a certain target and modulate a disease. That's been trying to be done through the use of AI by quite a few companies, and a huge amount of money is pouring into that. But that's just not an area that kind of we are going to compete in, because the risk profile doesn't match. These companies are too big. Then it's quite high risk, and I think it definitely comes down to where to focus. You have to be really selective in this area, and we, the kind of your sort of note on the rising tide. I think if you look at the clinical research organization market over the last 5+ years, that has been a big case of kind of all ships are all ships rising in that water, because there's just basically been huge spend in terms of accelerating R&D. Drugs are harder to discover, more complex, and you don't necessarily have to choose the best CRO, but most of them have done pretty well, if not very well. So there are certain markets and certain parts of the healthcare sort of sector and value chain, I think that we try and focus on sort of, I suppose, the more niche areas, really. IXICO is quite niche in terms of therapeutic area. I think our businesses, they have to have differentiators, they have to have market drivers, but they have to have sort of some immunity to someone like a Google or an Apple, coming in and just completely eating their lunch, which I think they mostly do.
Yeah. And another one which absolutely fits that description is Bioventix, which I think is basically a high affinity sheep monoclonal antibody provider or developer, etc. For sort of
what does that mean, Paul?
Exactly. Well, as I understand it, it's usually very good for medical diagnostics. It acts as reagents, and therefore they can use the science, or that they sell to the diagnostics boys. I don't know who that is, but I'm guessing people like Roche and people like that. But to do sort of heart disease and cancer and fertility and all this sort of drug abuse testing, etc., which has been, front and center. Obviously, they don't do COVID testing, and when you sort of like, I mean, the market for antibodies, I believe, is well over $100 billion. So they've got a big runway ahead, and the shares. I mean, all I would say is that the shares are reasonably well priced. But I mean, what's sort of their real USP? Because they make EBIT margins of 75%, which is is that sustainable? Obviously, it is at the moment.
Yeah. I mean, just cutting through the kind of fancy terminology that it's a very niche business, and they essentially it's basically an IP licensing business where they generate royalties on their IP is in being able to manufacture specific antibody-based reagents that are then used in reagent packs by hospitals where they go into diagnostic, sort of routine diagnostic testing, and those are the kind of analyzers or the machinery that those are owned, as you said, by people like Siemens or Roche or other very large multinationals. So they're kind of their IP is in having the capability and the scientific expertise to design a reagent pack for troponin, for example, which is their kind of big growth area at the moment, which detects, allows you to detect tiny fragments of the heart and the blood, potentially even before you've had a heart attack. So if you're having a heart attack or have just had one, but potentially allowing you to do that preemptively as well. And once they design that pack, they sell it into these customers on very long-term multi-year agreements. And the work is done, and so that's why they then just generate a very high kind of profit margin on the use every time those are used. So it's one of the most kind of resilient businesses from an operating and business model perspective that I've come across. It's very high margin, as you said, 75 to 80% EBITDA margin, very cash generative. They hold a sort of minimum cash buffer for a rainy day, and then as they generate any cash above that, they pay the difference out as a special dividend. So if you look at, I think the kind of ordinary dividend yield has historically been a 2.5%, but when you add on the kind of special dividends, which are pretty regular, it's been a kind of 4% yielder annually. And as you said, the shares they look well priced, but actually profit and revenue are they're not.
Are almost the same, aren't they?
Yeah,
the EBITDA drop-through rates are amazing. I mean, you could almost say they're on I think it's a 16 times revenue, but you could almost say that's a 16 times PE almost, certainly for drop-through revenue. For every pound which goes on, a big chunk of that goes through to EBIT.
Yeah, and we've got this across two different fronts, and we made the original investment a number of years ago, I think over 5 years ago, but our cost has been returned, more than our cost, I believe, has been returned through purely dividends. So, it's a very resilient dividend-paying business, very niche, high barriers to entry, very high quality.
Yeah. Well, I mean, I love it. And now just moving on, let's move on to sort of some software and sort of fintech and automation and stuff, because obviously this is sort of like, again, GARP investing with sort of long-term tailwinds, because consumers and businesses will need to reduce costs, certainly if it's given us a tighter environment. We've got sort of Netcall, Argentex, Fintel, Rosslyn and Trufin. Perhaps start with Netcall, which I think is an automation and call center software business.
Yeah, I mean, it used to be a sort of cloud contact center sort of software business, and it went through quite a big transition to the cloud, to SaaS. That is now actually really well advanced, and that has sort of increased the scalability from from a kind of product and delivery perspective, kind of multi-tenanted solution, single instance, but it's also improved obviously the quality of earnings. And if you look at, I suppose, if you look at the sort of set the share price performance against that for this year, they're decent H1 numbers, good growth. Shares are sort of derated quite significantly, and I think they have sort of pivoted quite well out of their sort of former kind of contact center area into this much more exciting areas, as you've said, in terms of driving automation, transitioning to SaaS. They bought a low-code software development business. Again, is that that's if you look at the multiples being paid in private markets across SaaS, cloud contact center software, low-code automation. There's a huge, and you compare that to what Netcall's trading at. It's a huge discrepancy. So I think it's quite an undervalued asset.
Yeah, it's only on 11. I just saw it. It's on 11 times EBITDA.
Yeah, I mean, I could probably find you businesses that in the private space people are paying 11 times revenue for. I think you're. Yeah, but and also like the balance sheet is ungeared as well. So you've got that which can either support further acquisitions or can enhance some shareholder distributions.
What about Argentex? Now, all things sort of like e-payments and Forex payments and stuff like that has gone to the moon, other than obviously PayPal has come off badly. But Argentex does more a sort of like mainly B2B stuff and high net worth individuals, foreign. And it's sort of like one of those stocks, actually, the shares have gone down. And I guess the question comes, is this a platform or is this a people business? Is this a services business?
Yeah, no, it's a people business, services business. It sort of provides corporate currency services. And, the model is, the sort of business model is really attractive because it's, it's kind of sales-led model. And it's high margin, it should be 30% plus profit margin.
Yeah.
And, if you sort of look at the, why is this interesting from a kind of market environment perspective? The attraction has always been, this market has been basically 80 to 85% dominated by the large incumbents, which have been the banks and the brokers, who have been very inflexible and rigid on pricing, who've provided poor quality of service, who haven't embraced technology, and who haven't really catered to, the lower end of the corporate market or the SME market. So the kind of the investment case from a market perspective is independents like Argentex, Alpha FX is another listed business. They've been taking share from those incumbents. I think Argentex has struggled, over the last sort of year or so in terms of having kind of slightly weaker trading than expected, and that has really been driven because of kind of uncertainty from clients initially, from as a result of COVID, which has reduced the kind of transaction frequency. So that is, that hasn't been that well received by the market, and that's sort of pushed the shares down. But actually, if you look at what has happened under the bonnet over the last 2 years, during COVID and after COVID, there's been a huge amount of progress that's been made with that business. So, they've expanded their team, across kind of exec and also senior management. They've really embraced the kind of building out of the tech proposition. So perhaps something that they hadn't launched previously, they've now been on the front foot with that. They've expanded the sales team. And, so there's been quite a lot of sort of self-help with that business. And, the latest results, sort of revenue growth is 23%, margins are, I think, 30, 31.
That's correct, yeah.
Profit margin. And, I fully appreciate why shares have derated if you miss expectations. But, from this point, the business is sort of 9-10 times PE.
Yeah.
And, if it's able to grow at that level with that sort of margin and, the drop through from additional revenue should be pretty high, then I think this is, looking, it might be undervalued and so quite an attractive kind of growth opportunity from here.
Yeah, no, it does look extremely cheap, no doubt about it, for a sector that is got secular tailwinds, no doubt about it. What about Fintel, which I understand is sort of like a provider of, sort of, again, finance provider of all things and services and picks and shovels to the sort of the IFA and the investment industry.
Yeah, it is, and it has been on a bit of a transition journey, I would say, and it is evolving from being essentially, as you said, an outsourced compliance service provider to IFAs, but it sort of migrated into being a kind of two-sided digital technology and data platform for fund buyers and fund management groups, and that was basically through the acquisition of De facto. I think it was in 2019. That was probably. So that kind of transition, that journey has been sort of slightly delayed by COVID, but we're now seeing that kind of coming back to the fore. We did quite a bit of diligence on this business, and particularly on that sort of digital transformation piece through kind of one of our in-house operating partners, which gave us quite good conviction on that. The other things at play here are you've got a balance sheet deleveraging story through cash generation and non-core asset disposals. As you see that transition towards the two-sided digital technology platform, you're going to get an improved quality of earnings through subscription and SaaS revenues rising as a proportion of the total mix, and you're going to see enhanced growth. So I think you've got again quite an exciting story here.
Yeah,
you've got growth, improving quality of earnings, cash generation, and ultimately, could be a re-rating as you sort of evolve from services to more technology focus.
Or bought out by somebody, because there's so much M&A going off, isn't there, in this whole area? So, I'm with you. Now, a couple of sort of like small ones. Rosslyn Data Tech, which is basically it's got sort of like a number of different moving pies, but the main part is their rapid a software platform, and I think that does sort of like supply chain procurement, big data, AI, which they've just been transitioning. And then they've got a couple of assets that they may or may not sell off, I think, which is a customs business, import export software, and then likewise their unstructured data business that they might sell or whatever like that. Do you want to take us through? Because it's really quite a small company, actually. It's only it was less than 10 million market cap.
Yeah. Yeah, well, actually, I mean, Rosslyn and Trufin, both kind of similar in being a bit of kind of special situations, some of the parts. Right? And I think, Rosslyn, but both the acquisitions they did were pretty opportunistic, particularly the customs cloud product, which I think they acquired for something like £50,000.
Yeah, that's right. Out of receivership, yeah.
Yeah. The core part of the business is what was called the Rapid platform. Started out as being a kind of data analytics proposition, moved into being a kind of master data management platform across the supply chain. That I think the challenge with that business and the business overall has been really demonstrating kind of strong organic growth. That's been the challenge. I mean, it's a kind of predominantly SaaS business, diversified across sectors, across customers, high recurring revenue, low churn, and the bit that could really transform this business is getting that organic growth. So that has been the big focus, and that what has to change to drive that. There's been a lot of change that has sort of happened within that business, and the management team have done a lot of work on really sort of refocusing to drive organic growth. The way they've done that, they've kind of sort of gone back to basics and kind of looked at their core expertise is really in data extraction and kind of enriching that data. They've decided to kind of streamline and focus route to market through partnerships to increase scalability. They've done quite a material team build in terms of at the senior management level. To build out the sales, marketing, and sort of technology piece. And, then, probably the most important thing, or one of the most important things I think really was the kind of product market fit as well.
Yeah.
So really working out because this data analytics space is huge, but they're a very small business. And where do you play? What's your kind of IP? How do you target customers? And then how does what does your product have to look like? How does it have to appeal to the customer? How does it fit with the market? And sort of getting that right. They've done a lot of work on getting that right, and that has then led to sort of development in the platform, which has culminated in a kind of a relaunch of the brand and also a relaunch of the platform. So I think it's now the Rosslyn 10. It's the new product.
Yeah, and I've seen it on Twitter and LinkedIn actually being advertised. So it must be sort of it's sort of making hay. There's no doubt about it. Or sort of like making some impressions anyway.
Yeah, and then so I think that is, I think that's launching soon. So I guess all eyes will be on delivering organic growth there. In terms of valuation, I mean, this is very cheap.
It's less than one time sales, isn't it? If you put all the pieces together.
Yeah, I mean, it's probably at or around 1 times ARR.
Yeah,
and so this, even if you don't get any organic growth, you could probably just sell all 3 parts of the business and return more than the current value. So I think there's good value there.
It's an unbundling play. What about Trufin then? Because again, I mean, that's had some good contract news with its Cetargo software that it basically joined up, or I think Lloyd's has managed to sign. But the thing, the other jewel I've heard about is this is their gaming software, Mortal Shell, PlayStack or something.
PlayStack, yeah. I mean, I think PlayStack is, so look, this is a combination of 4 businesses. I think PlayStack has been a bit of a sort of jewel in the crown, really. It's the sort of gaming development business. This is a really exciting growth market. And, we've seen the likes of Team 17, Sumo Digital, Devolver, Codemasters. We've seen those mostly perform very well and, continue to grow, as that sector grows and as the demand for kind of outsourced development grows, as well as sort of, contributing to your own titles and your own IP. We were a shareholder in Codemasters as well, which was sold, and the multiples are they're pretty high on these businesses.
Well, Microsoft just bought Activision as well, didn't they?
Yeah, exactly. And so I think PlayStack is it's not as big as those businesses, but it's a decent sized business. So you don't have to put on a huge multiple to kind of make that look exciting. Cetargo, that's sort of an invoice financing software platform. They'd been sort of through a very comprehensive kind of trial and pilot with Lloyd's, which has recently resulted in kind of winning a contract with them, and also a strategic investment of, I think it was £5 million for 20%.
That's correct. Yeah.
Which is, that's been terrific news. And if you look at some of the modelling of the number of customers and the average sort of revenue per customer within Lloyd's customer base, what that could do to the value of Cetargo. I know it's kind of theoretical, but it again, the kind of the direction of travel with Cetargo is potentially really exciting. You've then got 2 other businesses, Virtus and Oxygen, which are a bit smaller, but they're probably not valued at anything really in the business at the moment, and they're definitely worth more than 0. So again, this kind of bit of a sum of the parts play, but actually I think Cetargo and PlayStack, I think now you got 2 really exciting assets, which are I'm looking forward to see how those sort of unfold in terms of trading, and then ultimately what happens to them, whether one gets bought or spun out or but I think there's a lot of value there.
Yeah, well, if there's smart investors on board like yourself, then I'm sure you'll be encouraging
lots of words, Paul.
Well, but encouraging management teams to realise shareholder value, but they're probably directionally incentivised anyway to do that. And just finally, then we've just come to a couple of legal companies that obviously the during the pandemic, the government put in some pretty sort of like, well, creditor protection measures through the courts. It stopped companies going bust, or not stop them, but certainly, stop that, put difficulties for those businesses to keep people in jobs. And so you've got a couple of them. You've got Begbies, and then you've got Anexo. And do you want to, let's start with Anexo first, which basically is it's sort of like, again, a bit of self-help, but it's seeing an increase in its bond turner division through collections as the court sort of opens, and it sort of like helps consumers sort of like fight sort of or be compensated, doesn't it, for no fault accidents or incidents whereby they've been harmed.
Yeah, it's basically, the proposition is directed at the not at fault motorist. Both in terms of kind of car and motorcycle. They recently announced fairly recently, a partnership with, I think, MCE, which is
that's right,
large motorcycle insurance business. So, but yeah, they're a specialist sort of they're integrated legal services, which is the bond turner bit, and credit hire business. And so they essentially look at cases. They look at cases where they work out whether the motorist's at fault. Do they want to invest in that case, take it on, and then they provide credit hire to the individual, to the consumer, and then where they win that case and it's settled, they're appropriately compensated for it. And
it's a no win no fee type stuff, isn't it? I guess.
Yeah. And during the pandemic, the court system, was kind of shut effectively. So that reopening has, that's been hugely supportive of the legal services bit, of the bond turner part, which has allowed, these cases to start getting settled. That has accelerated cash collection. I think they said fairly recently that some cash collection was running at kind of all-time highs.
Yeah, that's right.
And that's obviously great, because then that allows them to further invest in new cases. And so it kind of resets that sort of virtuous circle of growth. And I think they also, these businesses, this is why kind of small cap businesses are always quite interesting, because they're very entrepreneurial and they kind of never standing still, evolving, moving into new spaces. And Anexo sort of moved into a new area in housing disrepair.
That's right, yeah.
Which it looks quite attractive into its early days, but it looks attractive in terms of the market backdrop, in terms of the kind of move from shared ownership to or property ownership, to the kind of rise of rental properties that they're seeing across the market, and also in terms of, I think there was some fairly recent legislation in, I think it was 2019, it came into force, which is again kind of supportive from a kind of tenant perspective in terms of that housing disrepair market. So that looks like a potential another avenue for growth as well. So,
it trades on a 7 times PER, and even if you put in the debt, it's sort of like on a 6 to 7 times EBITDA. So it's sort of like very, very cheap. And then just moving on to sort of Begbies Trailer, which was effectively the archetypal insolvency practitioner years ago, but now has sort of branched out into lots of corporate services. There's a bit of M&A, property services and stuff like that. But again, given the courts have been shut, and there's a massive backlog of insolvencies and administrations coming through, the opportunity and the runway must be pretty attractive. It's only on 11 times PE as well.
Yeah. So they've branched out into sort of ancillary professional services. There's most of the business is still kind of insolvency driven, and those sort of M&A and property services there's a kind of common thread in terms of, there might be, with an insolvency, maybe there's a kind of property sale, or, maybe there's something business related that requires corporate advisory. Not in all cases, but, there's a bit of commonality there. And this business has performed really well during actually what's been a very benign market. During COVID, when the levels of government support were, there was significantly elevated, which has sort of artificially kind of propping up businesses and the economy. And so, despite that, this business traded very well, continued to grow, generate good profits, pay dividends, and it is definitely a sort of counter-cyclical play. And I think from here, I think it should continue to sort of be quite robust, this business. But I think the exciting thing is really, as we see a market turn, we talked about cost of living crisis. That's not just consumers, but what about small businesses where, actually energy costs for a business, or rates going up, or the cost of a loan, interest rates going up, that can
even large businesses going bust. I mean, you had studio retail not go pop a few weeks ago.
Yeah, and they have exposure, across both SMEs and sort of larger transactions, and I think that actually the recent market data showed that in the kind of smaller end, the kind of volumes of insolvencies and administrations were coming back.
Yes,
but at the higher end, they hadn't started to turn yet. And so I think that will be a critical inflection point when we see, as the full extent of the government support is unwound, but as that, it takes time for that to kind of filter through the economy and to impact businesses. And so I think as that, starts to unfold, it's, potentially the next sort of a further order impact of COVID. And so, I think that, that will be that as that market begins to turn, this business you could see quite a material change in kind of pace of growth.
Yeah, no, and it's good diversity for your portfolio. Both
exactly.
Sort of, in tougher times, these ones should give you some sort of like stability on the portfolio construction. Well, thanks very much for your time there, Brendan. Lovely insights, and I'm certainly going to go away with plenty of research that I'm going to go and do. Just in terms of investors, if they want to sort of like put some money into to Gresham House, into your funds, where is it best to sort of contact points? Is it the website or you, or how best to do it?
It's probably our sales team.
Okay.
Yeah.
And that's on the website, I guess.
Probably our sales team on the website, I think. I'm not sure. I'm not sure I'm allowed to do any sort of financial promotion.
Oh, okay. Sorry. Right. Okay. So look on the website, and you'll see the funds. But that fantastic. Really appreciate your time and great ideas. And I think it really underlines, doesn't it, from what you say when it comes to the outlook for equities going forward. We've just run through 15 stocks there, and all of them have good long runways, and that most of them on really very compelling valuations. So plenty of people to chew on.
Yeah, great. Thanks, Paul.
Okay, thanks very much, Brendan.